I am a happy camper, says Logan Mahtashami, the chief lead analyst for a Housing Wire publication. Why is he a happy camper? Because the housing market has moved away from the savagely unhealthy levels of 2022. Why? Because an average time on the market right now for a home in the US is about 33 days. He was crying and screaming loud last year when we were under 20 days of average time on the market. What does this mean? He says two terrible things could explain why the days on the market were below 20. Last week, as far as inventories, they fell over 11,000 homes. Why? Again, this is all because mortgage interest rates dropped a bit in January and homes went under market. Pending home sales report confirms it. Pending home sales rose 8.1% from December to January, which was a substantially higher number than what economists have anticipated. And in comparison to an increase of 1.1% in December, things are looking better. Sales are still down. They're down 24% comparing to December of 2021, but that's a much better number than comparing November 2021, which sales were down almost 34%. It is considered a very forward-looking indicator because those are homes on the market and those are speaking loudly of demand out there. National Association of Realtors chief economist Lawrence Yoon says buyers responded directly to better affordability with dropping mortgage interest rates. Unfortunately, after February 3rd employment report which showed substantially better numbers than what any economist, myself as well, anticipated, rates have gone up, though we are truly looking forward to what happens this week with employment data for February, and we are truly hoping and keeping our fingers crossed that rates are going to adjust after that report. Case-Shiller Home Price Index, the gold standard for home appreciation, showed prices fell 0.8% from November to December, but they're still up 5.8% comparing to December of 2021. On single-family front, and only single-family homes dropped 0.1 in appreciation, but that's still a 6.6% rise comparing to December of 2021. The bottom line is, according to Managing Director Craig Lazara of the S&P, that they are overall down about 4.4% from the peak in June seen in 2022, but that is a very far cry from the 20% drop that some gloom and doomers have been scaring us with. The biggest indicator in this Case-Shiller Home Price Index in the 10 city and the 20 city index. The 10 largest and 20 largest cities have dropped or shed appreciation at the fastest level. Why? Because those were the same markets that showed the highest appreciation levels back in 2022 when things were crazy. So if we take out the big cities, things are going to look a little less gloomy for the entirety of the country. Now, one thing to note, Chicago happens to be within both the indexes 10 and 20, and Chicago seems to be the most affordable of big cities in the US. On the jobless front, total people claiming unemployment right now fell a little bit last week to 1.655 million. Employers are looking to hold on to their employees as evidenced by these numbers. That's all I had for you today. Beata Bukowski, Fairway Independent Mortgage.